We'll be talking this morning, by the grace of God, on this subject, pathway to a secure financial future, creating, protecting, and growing personal wealth. I'm going to move off the stage so you can see the screen. I was trying to avoid this. I've been asked to speak a bit of myself. Okay. My name is Obafumilayo Agusto. I am a chartered accountant, long-standing chartered accountant, and I have many years of both personal and institutional experience in the subjects in which we're going to be talking about. I hold current and past positions as non-executive directors in financial institutions such as a mortgage bank, such as a commercial bank, such as pension funds administrators. And at different times, I've been members and chairs of investment committees and risk management committees and other committees of the board. Thank you. Now that we've gotten that out of the way, let's go to the business of the day. Like I said, I'm going to try and not block the screen. Now, this is an overview of the things that we're going to be talking about. Remember, the subject itself is pathway to a secure financial future. We'll be talking about how to create, how to protect, and how to grow personal wealth. So next slide. Just by way of introduction, when you're talking about financial security, you're talking about financial independence. We're talking about the capacity to be able to meet day-to-day expenses as an adult at any age, whether you're working, whether you're retired, without A, compromising your standard of living, and B, without any external financial support. That's the point where you can describe yourself as being financially secure or financially independent. So a lot of the questions that we're going to be answering will revolve around how can I create or maintain such financial security? How do I create? How do I protect? How do I grow my wealth? What types of assets should I be investing in? And how do I prepare in case I'm still at the preparation stage? Typically, preparation for a secure financial future is undertaken over most or all of one's active working life. And such preparation includes very good financial literacy, very good financial discipline, and sound and safe and profitable investing. Next slide, please. Next slide, please. As it is with most things in life, unexpected challenges can arise. So listed here from 1 to 6 are the kind of things that can happen from time to time. So we're also going to be talking about how we can position ourselves to mitigate the impact of these kind of challenges whenever or should they ever arise. Next slide, please. Now, what you have on this slide, the black line is the active income of any individual, and the red line represents the living expenses. Whilst one is young and still working actively, it is important, it is crucial, it is indispensable that expenses must be kept below income, whatever the level of income is. For a young person or for somebody who is still working actively, to have more expenses than income is nothing but a recipe for financial troubles or disaster ahead. So it is important. You see, because a time is going to come when that active income is either going to reduce or maybe even disappear entirely, and living expenses will still be there. So the question is, at such times when active income declines or disappears, what then do we do? Typically, for most people, it's by way of passive income that the answer lies. Next slide, please. Active income, by definition, is income that you obtain from working for money. Passive income is the income you obtain from money working for you. It is important that as we all grow in age and get older, our passive income must continue to increase, particularly as we approach or get to the point when active income begins to decline or maybe even dry up completely. It is crucial to the subjects that we're talking about. And the ideal type of passive income is one that increases with inflation. There are some passive income that as inflation or general price increases occur, they do not increase. But there are also some types of passive income that they increase with general price levels. We'll talk a bit more about that fourth point. Next slide, please. For us to really understand the subject, we must, the issue of inflation and the issue of compounded investment return is fundamental to the subject. So we're going to spend a bit of time talking about this. Next slide, please. Now, what you have on the left-hand side is Nigeria's official inflation record for the last 20 years. Official inflation record. The 20-year average from this record is about 14.4% per annum. That's the average from this record. So what that means is that over the last 20 years, general prices on average has gone up 15 times. So something that costs, let's say, 1,000 naira 20 years ago, generally speaking, is 15,000 naira now. Something that cost 1 million is 15 million now, and so on. And then within the same period, exchange rate, how do I say this in English, is times 11, if you understand what I mean. In other words, if you needed 1 million naira to buy a certain amount of dollars, now you need 11 million naira to buy the same amount of dollars. So remember our definition of financial security, financial independence. Ability to meet day-to-day expenses, irrespective of where price levels are at. Is it possible? Yes, it's possible. Next slide, please. So, remember I said that we needed to explain the concept of inflation and the concept of compounded investment return. Now, compounding is a process in investment where income generated from an investment is continuously reinvested along with the original amount to generate additional income over time. The income from the investment is reinvested continuously over time to generate additional income. So the income from the investment also work at creating more income. I mean, this is a process that when you stay with it for a long period of time, it generates significant income relative to the investment amount over time. So we'll take an example on the next page. We'll assume there are two people, maybe even co-workers in the office. One is John, one is Mary. Both of them invest 1 million naira, and they neither add nor remove from it. The only difference is that John receives his investment income, he consumes it religiously, and Mary receives her investment income and reinvests it. Please go back to the last slide. Also religiously. So apart from that 1 million, there is no additional external investment on the part of Mary. Neither is there any depletion or addition on the part of John. I hope I didn't mix it up. Okay. But you understand what I'm saying. So Okay, no. Mary reinvests her income religiously, income from that investment, not a fresh income. Whereas John consumes the income from the investment and only leaves the original investment. So after a 10-year period, next slide, please. After a 10-year period, the question is, how much will each person have? John will still have his 1 million because he did not withdraw it. It was only the income that he was eating, so to speak. Whereas, over that 10-year period, Mary has 9.3 million. A little bit over 9 times what John has. Now, that 9.3 million, what is it made up of? It's made up of the original 1 million invested, and then the interest on that 1 million, 25% of 1 million is 250,000, right? So over a 10-year period, 250,000 in 10 places will be 2.5 million. So the original money invested and the income on that original money is 3.5 million, right? So what you have on the right-hand side, 5.8 million, is actually only income on income. Sir? Yes. Now, it gets even better. This is over a 10-year period. The same illustration, let's now extend it to a 20-year period. The difference is even more stark. Is 1 million naira versus 86 million, almost 87 million. And then when you look at the original money invested and the income on that original money for 20 years is 6 million. 1 million plus 5 million of income. So you have a whole, out of 87 million, you have a whole almost 81 million. That is purely income on income. Now imagine if Mary, in addition to the initial 1 million, had been adding, let's say, 20,000 a month, 25,000 a month, 50,000 a month. And then I would also like to stretch your imagination. For you to imagine, we started with 1 million. If we had started with 100 million, how much would that be? If we had started with 10 million, how much would that be? Or even if we started with the 1 million, but every subsequent year, by adding 83.33 thousand a month, we add another 1 million every year. It's quite significant. So the message there, or the lesson, is that in long-term investing, income from continuous reinvesting of, what you generate from continuously reinvesting income exceeds the original investment by a very, very great amount. And you may want to ask, this example of an investment that is yielding 25% per annum on average, because at times rates may be lower or higher, or returns may be lower or higher, whatever. But on average, 25%, is this something that is practical? Is it attainable? Well, I can tell you that in the last 20 years in Nigeria, investing in Naira, this was very, very well attainable. I'll give an example, which I gave in the first service. 20-something years ago, I don't remember exactly, but it's somewhere between 20 and 25 years ago. My wife used to be the head teacher of Redeemers International School. And the school or the church, RCCG, wanted to establish boarding house along the Lekki Expressway. At that time, Pastor Esco was the lead pastor in COD. And the school, or the mission, that's the right word, bought land at Lakwe, per plot at that time, do you know how much it is? It was 180,000 naira per plot. That piece of land today is worth at least times 100. What you're looking at here is times 86. So I'm saying that to say that this kind of example is not a classroom example, it's real life. Now, again, like I said in the first service, I would not like to mention names of companies, right? But there are companies listed on this, our Nigerian stock exchange, that if you invested in 20 years ago and reinvested, you would have gotten this kind of returns and even more. Okay, looking at this, you might then say to yourself, okay, what about inflation? What about devaluation? What I'd like you to notice that over this 20-year period, it went from 1 million to rounded up to 86, 87. That's 86 or 87 times. Inflation was only 15 times. And devaluation was only 11 times. So even in US dollars, this would have been 8 times over a 20-year period. Inflation adjusted is at least maybe about 17 times. Sorry, what did I say? 7 times, not 17 times. So the point I'm trying to make is that these returns, which I said is very attainable, is very practical, produces significant return even in real terms. Real terms simply means in inflation-adjusted terms. Next slide, please. So this table just shows you how this compounding works in terms of actual rates and actual periods of time. The lesson from this table is that the longer you stay in the investment and you stay reinvested, the more your multiple. And then, of course, the higher the investment returns, the more your multiples also will be. Okay, I'm watching the time because we need to leave enough time for questions and answers as well as for prayers. Next slide, please. This is the returns from Nigerian PFA industry. Just look at the last column. The last column is average over maybe a 15-year period. You have the active and the retired, but just take the average of the two, is about 12% per annum. The honest but bitter truth is that the PFA industry has not been able to grow our investments at a rate that is faster than inflation. And what that means is that for most of us, except maybe a big CEO, the money inside that account when you retire will not be enough to retire on. Pension Funds Administrators, PFA. Everyone in Nigeria who is working is required to have this account, right? And you get your statements or balances like every month when money goes there. Now, but there's one thing I want to mention here. The PFA is mandatory. There's a mandatory amount that goes from your salary every month. But you can choose to make additional contributions. When you make those additional contributions, they are tax-free. For most of the phases I'm looking at here, your marginal tax rate is probably about 20%. So what that means is that instead of you to collect 800,000 in your pocket, that's the after-tax salary, if you put it back, they will credit you with 1 million. So instantly you make a savings of 200,000, 20%, right? However, so that 20% will add to these investment returns that you're looking at. The only proviso is that you're not allowed to withdraw that money until after 5 years, which for most people is actually good. So you can't go back, because if you don't want to go back next week or next month, of course it will be taxed. But if you leave it for at least 5 years, when you're taking out the money, that tax that you did not pay is gone. So it adds to your investment returns. So another way to look at it is that if at the end of 5 years, let's say you put 1 million, sorry, I'm using millions. If you put 1 million, at the end of 5 years, if ordinarily it would have become 2 million. Sorry. No, I don't want to make it complex. The thing is that you save the tax forever. So that tax is an additional investment return, right? So instead of collecting 800,000 or 80,000 in cash, you invest 100,000, and that 100,000 is what is working for you. So you already have a head start of 20 or 25%. So it's something that may be worth looking at for people who are still in active employment. Next. So very quickly, I want to go to the kind of investments that can help us to grow wealth. And we're going to be talking on one part about long-term investments, where you have real estate, equities, and long-term bonds. And then we'll talk about short-term investments. Next, please. Now, real estate. Real estate is real estate. Is land, is building, or a combination of both. There are several advantages of real estate. The value moves with inflation. If it's a rental real estate, the value also moves with inflation. The price is not volatile. And it is almost, in fact, it is impossible for you to lose your entire capital in real estate unless the title is defective. In other words, the person that is selling to you does not have title. Yes, you can lose your money. But once you make sure that your title is not defective, your money is very safe when you invest it in land. Disadvantages is that it's not very liquid. You can't just sell it, as in wake up in the morning and say in the afternoon, I want to sell it. And then it also has high investment costs and also high transaction costs. The cost of changing title is not beans, right? However, there is a financial technology development that helps with that high entry cost. You know, when you talk about investment in real estate, for most people is that that one is not play. So, next slide. There is something that is called a real estate investment trust. It's a real estate investment vehicle where, and I'm not talking about land banking here. I'm talking about companies that are regulated and that are listed on the exchange, where the only business they do is that they invest in real estate, collect rent, pay expenses, and give the money back to the shareholders. Right? So it's a way of for a retail investor with little money. And by the way, a lot of these investments that we're talking about, you don't need millions to start it. You can start with 5,000 naira, you can start with 10,000 naira. And then you can increase it as you are enabled. It's not about big money. But the only thing I can assure you that in the right investments, even those small investments, over time, will become big. I thought I would hear an amen. Okay, so real estate investment trust. So assuming that this building were owned by a real estate investment trust and everybody there were tenants, even if my own investment in the building is 0.0000001%, I'm still a landlord. And the thing is that it may be 0.00001% now, tomorrow 0.0002, 3, 4, 5, and so on, as I have the finances to increase. So that's a way of investing in real estate. And these things are available both in Nigeria and abroad. In fact, again, in the first service, I gave an example. There is a real estate investment trust that was on the market by one of the major investment houses. And the underlying asset in that particular real estate investment trust is the American Embassy in Abuja. And the tenant is the American Embassy. So when you buy into that real estate investment trust, you are landlord to American Embassy. I didn't hear you, amen. And so they make their distributions also in the currency in which they receive the rent. So they don't receive dollar and give you naira. They receive dollar and give you dollar. And my recollection of the minimum investment amount for that particular one is either 1 or 5 million, but I think it's 1 million minimum. So I'm saying that to say this, that some of these things are attainable. High quality, high grade investments are available at a rate of investment that is not beyond what an ordinary person can, is not in the billions or in the millions. And you can always start your investment journey in very, very small amounts. Next. The next one is investment in shares. Now here, you need to be careful because, yes, a good thing, value moves with inflation, dividend, but you need to be selective in what you're investing in. Again, in the first service, I gave the example of AfriBank. Please help me with the examples, those who are here. Starcoms, Savannah Bank, companies have come and gone. And like I said in the first service, if you invested 100, whatever you invested in those companies, what you had eventually was not 10% or 15%, If you lose 70%, you see that it was 0%. So one needs to be very careful. But in the right kind of investments, yes, you can grow your wealth. Investments can be done in little bits. I'm trying to move so that we can ask questions. Go ahead. The other one is long-term bonds. In the long-term bond space, if you have big money, you can play in the big segment of the market. If you have little money, you can play in the lower end of the market. There is federal government bonds that are available in units of at least 5,000 naira. If you want to be in the upper segment, you need at least a minimum of 50 million. So all of these things are possible. Next slide, please. Okay. Now, those first three that I mentioned, they are for monies that you want to invest in the long term. It's not money that you need for school fees next term. It's not money that you need for rent in 7 months' time. When you need to keep money for rent in 7 months' time, school fees in 2 months' time, or in 3 months' time, you need to come to the realm of short-term investments. Things like treasury bills, money market funds, bank deposits, and so on. I'll talk about money market funds in particular. And again, don't laugh at me. A money market fund is a pool of funds that is invested in money market instruments. Anyway, what that means in simple English is that there's an institution, like any of the banking institutions that you know of. Their subsidiaries, they have these funds where they pool money together from investors, and those monies run into billions, in some cases into trillions. So when they're investing that money on your behalf, they have a strong bargaining power. It's not your 150,000 that you put there. That your 150 has now become billions or trillions. So they get very good rates. At today's rate, you probably can get about 20% per annum in your money market fund. So if you are saving for your rent, saving for school fees, that's the place to put it. You can also have bank deposits, fixed deposits in particular, not savings, not current accounts. So even money that you are going to need shortly, you need to get that money to even be working for you, right? Commercial papers are typically issued by companies to borrow money short term. Most of the commercial papers that you come in contact with will be the ones that have been approved by the Securities and Exchange Commission. They must have scaled a certain rating hurdle. And there was even one that was issued by a bank that closed last Friday. And you could get as high as 23, 24% per annum over a 6 months to a 9 months period. There's also domiciliary accounts and so on. Now, all these investment options are available both in Naira and in foreign currency, depending on the one that you want. What about digital currencies? What we said about digital, or what we're saying about digital currencies is that compared to real estate, compared to shares and bonds, this digital currency is a new kid on the block. The investment options that we discussed earlier, they are things that have been tested for decades, centuries, even millennia, right? And there have been proven ways of storing and growing wealth. Now, but we've seen the digital currencies emerge in the last 1 or 2 decades. And my advice, personally, would be that if you want to invest in digital currencies, one, do not put a big percentage of your money in digital currencies is very, very volatile. And even when you want to invest, you can invest in a fund that is managed by one of the global asset managers. There are many of them that have cryptocurrency funds. So they are doing the trading on your behalf. And then, of course, invest in knowing more and more about it. Next slide, please. Yes, we'll spend some time here. This is about wealth creation and wealth and growing your wealth. Okay, we'll start from the left side. There are a finite number of ways that you can create wealth. One is to create a very successful business. Now, don't be intimidated by Facebook and Google and Twitter and so on. You can also create a successful business with your hands or with a skill that you have. At times, your seemingly small side hustle can give you, well, a modest income, but that modest income can help you to accelerate your investments. So that's one. Another is to consistently invest in successful companies or consistently invest in real estate or other investments. Your investment selection criteria must be very, very careful to make sure that you are not gambling. Investment is not gambling. Investment actually is a skill. There are investment management qualifications, there are investment management professionals, there are investment management ethical practices. So properly invested over time, just like we saw in some of the examples we used earlier on, you can also build wealth. Now, in order to grow your wealth, particularly when you are still at the building stage, you need to reinvest. You need to compound your investment returns. And you need to invest in the kind of assets that not only increases in value with inflation, but also the income that they generate also increases with inflation. Like we said earlier, real estate and shares in successful companies, they fit the bill when we're talking about increasing in value with inflation and income that also increase with inflation. These are principles that work across currencies. Whether you're investing in Japanese yen, Nigerian naira, Ghanaian cedi, or Australian shilling, these principles apply. And then you need to grow your investments to the point where your investment income, your passive income, actually exceeds your consumption needs. Some of us may look at it and say, do you know my consumption needs on an annual basis? Yes. And I'm saying that these things are actually attainable. They're not pie in the sky. You can't have investment income consistently that grow with inflation that exceed your consumption. Now, there's an important distinction between being rich and being wealthy that will further underscore that third point. You see, when somebody is rich, the person is able to afford the good things of life, a good house, a good car, afford to travel, wear designer clothes, designer shoes, designer glasses, designer everything, right? But the fact that somebody is rich does not necessarily mean the person is wealthy. Wealth is about, the main distinction between rich and wealth is about sustainability. When somebody is wealthy, there is an inbuilt self-sustaining mechanism in the person's in the person's assets. The person has gotten to the point where the assets are generating so much income, right, by themselves, that you can't even finish spending it. And if you really want to spend it, you'll find out that you're just spending the money to buy another asset. So let's say somebody, for the sake of illustration, their passive income is 10 billion, whatever, right? By the time you now say, okay, I want to finish spending this money, it's called, okay, I'm buying 2 houses in Banana. those houses you are buying are generating an additional income for you. So, and one of the sad things of life is that somebody can be rich at a particular point, and later in life, the person is no longer rich. Because if anything, being rich actually positions you well to invest your way into wealth. And I'm not saying that you need to be rich to invest your way into wealth. Consistent investments that seem so little to you over a long period of time, with the investment income consistently reinvested, can also lead to wealth. I've seen it lead to wealth in several cases. There are people that I know one-on-one in this church who have been practicing these principles for upwards of 30 years. In fact, there's a particular individual that if during the Q&A session he chooses to identify himself, so he's a man, he told me that he learned some of these principles from his mother, and that by the time he started working, he already had an investment portfolio. In other words, his portfolio did not start from before he started working. So, we're talking about growing, creating, protecting, and growing our personal wealth. Our time is fast spent. Next slide, please. So, we all need a personal assessment. First column is description of assets and liabilities. Next column is assets that represent investments. Assets that represent investments are assets that appreciate. Assets that represent consumables are assets that depreciate. So the latest iPhone will come under consumable. No matter how big your car is, even if it's Rolls Royce, it's under consumable. But let's say real estate, no matter how modest, comes under investments and so on. And then just use this to test and see whether your assets are more skewed towards consumable or what we call wasting assets or appreciating assets. And also see what kind of liabilities you have, what kind of net worth do you have. The more you have under investments, the more passive income is generated. The more you have under consumption assets, the more depreciating those assets will be. Next slide, please. Insurance is extremely important. We must always have our major assets properly insured, and I'm not talking about third party. We should insure our health, and then we should also insure our life, particularly when you are the major breadwinner. In the first service, I shared an example. I'll share it again very quickly. Somebody that some of us know, unfortunately, he died about 15, 16, or 17 years ago. Left the wife. He was the major breadwinner. Was working for an oil company. Left the wife with a house in VGC, a mortgage on the house, and 4 little children to train. Fortunately, he insured his life. That's something called mortgage insurance. So the moment he died, the insurance company paid every single kobo of the mortgage that was left. I think, not that I know for a fact, from the company, there are some final entitlements that the family got. Anyway, fast forward 16, 17 years later, the family is fine, the children have all graduated, they are doing very well. So when they say you should insure your life, don't say to Fiakwa. And our mommy here, she doesn't like me calling her mommy. She told us when they shared their testimony about the benefits, the importance of having health insurance. When you hear some of their testimony, we went to this hospital, we came from that hospital, it is health insurance. Okay. Unless, of course, I mean, if you have billions of dollars, you can say that, how much is it? I'll pay. Okay, next slide, please. So in summary, financial discipline and focus is required. You must keep your expenses below your income. There are no excuses. To do otherwise is to be caught in financial disaster. The only time you can consistently spend more than you earn is if you are consistently in debt. And that will not be your portion in Jesus' mighty name. The second point is to recognize that active income, that money, that salary you are earning, don't think that it is only to meet your immediate needs. It is both for consumption and investment. And that's the truth. Long-term investments in non-speculative assets whose value and whose income grow with inflation is indispensable to creating and growing wealth. In fact, the opposite will be to destroy wealth. So if I have even 1 billion, but the thing keeps depreciating, that's wealth destruction. And that will not be our portion in Jesus' name. So even when you have a successful business, whether it's a modest business or it's a big business, form a habit of diversifying and investing as indicated above. Investment income as much as possible during the wealth building stage, and be patient and focused during this stage. At all times, maintain proper insurance on your assets, health, and life. True wealth really begins at the point where your passive income exceeds your consumption needs. It is not theory. It is possible. It has happened. It's still happening, and will still continue to happen. So when you say somebody is wealthy, there's a self-sustaining mechanism that is built into that wealth. Thank you very much.